So what would happen is we would gather some questions, information from you, ask you very specific questions. What are your goals? What are your, your short-term goals, your long-term goals? Like, what does next year look like to you? Are you certain you're going to do, like, sometimes people are, I'm going to start this next year. I'm going to purchase this next year. I'm going to do this next year, and they're positioned for it and they're ready to go. Like the Dr. Nicole, she was like, I'm doing this next year. Right? Based on that, we did a phase 1, right? So phase 1 would be, you're not doing that right now. So let's look at those asset type strategies. Let's look at those investment type strategies, right? And then we'll have a phase 2 where when you start doing the other things, now you could keep doing the asset and investment type strategies year after year. And all that's going to do is increase your wealth because I always say save, tax, build wealth, repeat. Save, tax, build wealth, repeat. You can do it every year if you wanted. Some of them, not all of them, but you have the potential to do it every year. And I always say, like, if you don't do it this year, say you had the potential to save $100,000 this year and you don't do it, that's $100,000 down the drain. You don't do it next year, that's $200,000 down the drain. If you don't do it the repeatable strategies, if you don't do it the following year, that's $300,000 down the drain. Don't focus on what you're paying for the strategy. Focus. The real cost is what you're paying in tax, overpaying in taxes, right? So,
and it's not just 100. It's not 100K over 5 years. It's 100K that you did not invest. So 100K per year that you're not potentially reinvesting is more than 500K over 5 years because you're missing out on compounding too.
Exactly. Yeah. So that's the mindset shift that has to take place, because I know it sounds like, when you put it that way, that compounding effect over 10 years, that's a lot of lost cash, a lot of lost wealth, because that wealth could have been working for you.
Basically, I've been going towards something you want. It could be given, it could be reinvesting, it could be taking a year off.
Yes,
there's fun for your kids, creating legacy, so much stuff.
So much
opportunity cost.
Yes, so much. But back to the diagnostic. So essentially, that's what we will do. Again, it's tailored for you. So I can't. If someone comes to me, what I do for them will be different from what I do for others, because we have that discussion, about their unique situation, about their unique goals, their unique plans, and how can we, structure what we do from a tax perspective to make sure that it's in line with those goals.
Okay. All right.
When I do a tax plan, it's not me just telling you, do this, do this, do that, right? It's a written plan telling you exactly what to do, when to do it, and how to do it. And then we help you implement it. So it's not like I do a plan and say, okay, bye, nice to meet you. No, that's not how it works. And then I make sure, like I was saying earlier, it's an ongoing relationship throughout the year where I make sure that you're doing what it takes to maintain that deduction, right? Because one twist or one turn away from, the criteria could push you out of that qualification.
So here's what I'm understanding so far, and we're going to move to the non-W2. So we've talked about tax filing. I think tax filing is very straightforward. It's like filing all the taxes, submitting the paperwork, making sure you're not late. That's tax filing. And then there is the diagnostic, which some people actually think that's all tax strategy is. The diagnostic could be like, it's a consultation. Well, this is my consultation. This is my assessment. This is the thing. You can take it and go. But then there's another kind of tax strategy and planning, and more of like a wealth building, relationship, partnership.
Yes.
That is a year-long. It's a year-long commitment or multi-year commitment.
Yes.
It's like we've come up with the diagnostics, we've come up with the assessment and plan, but it's not, here is it, deuces, we're out. It's like, this is the beginning of a conversation, and we want to walk through meeting at different strategic points to make sure that it is actually implemented.
Yes.
Okay. All right. I want you all to understand that. So please go ahead.
Yeah. So you want to go to the plan itself?
No, I just wanted to make sure people understood that.
Oh, yes.
And all of that does matter, especially when you're having so people have the right expectation of who they're working with, because we've experienced that. what we thought we were working with a strategist. We thought we were in a relationship, but they did a diagnostic, and for them, we just dated one time, and we thought we were in a relationship.
No.
So y'all need to make sure
You need
that
to
if you're
define
dating someone,
you need to define the relationship.
yes, is this an open relationship? Are we free to date other people? Did you put a ring on it?
Make sure you define the relationship. And has the dynamic of the relationship changed? Or does it need to change, you know? Is this a long-term thing, or you just, is it a one-night stand kind of thing?
And I think that also does matter when you're comparing like fees and all of that, because people may go, and we're not going to go into this right now, but people may go, oh yeah, but I use TurboTax and they charge me, I don't know how much TurboTax or whatever, Jackson and something. I remember them from LA back in the day, and all those quick quick things too. Versus understanding what you're agreeing to will make the fees more understandable. There's more transparency about what value am I getting for the price that's been named. So thank you. Now let's move to the non-W2 doctor, which is where a lot of fun can be. So what are, like, someone is coming to you right now, they're like, I am a locums doc, or I have business, I've written books, I do all that. I know that those are the people that have more options for tax strategy and decreasing their tax liability.
Yes. They are. I mean, the tax code, the favorable parts of the tax code was written for business owners and investors. I mean, that's just a fact. The things that you see on the news, those are not the needle moving things. Those are not the needle moving things. The needle moving things are not hidden. It's only hidden if you're not intentional about seeking out a professional that can guide you to them, right? Okay. And that's where I make it not only easy, but accessible to my clients. So yes, the tax code is written for business owners.
What does that actually mean? For someone listening right now, people hear that a lot. And what ends up happening is someone opens up a business and they're like, but it's when I spend, that's when it decreases my tax liability, but I'm not enjoying the benefit that people tend to say. What does that mean, that the tax code is written for business owners?
I think a lot of the reason why people feel that way is because their tax strategist is not measuring that for them, how much they're saving. When there are ways that you can measure how much you're saving, then you understand the effect of the tax plan. Yes, there are regular deductions, 100%, but there are other business deductions. One of the things that come to mind is what's called QBI, Qualified Business Income Deduction, right? That is where you potentially can save. You get a 20% deduction. It's 20% of your business income, right?
Okay.
You get a deduction of 20%. Now, there's certain limits. In some cases, it's a straightforward calculation. But in other cases, once you hit a certain, it's called an AGI. When you hit a certain AGI, that deduction starts phasing out. But where a tax strategist comes into play is they would go and see what the exception to the exception to the exception is, and present to you opportunities where I would say, well, you're phasing out, but if you do this, or this, you phase right back in. So it's making certain strategic moves. It's not, oh, well, you're phased out. Right? It's you're phasing out, or you have the potential to phase out. And that's why the ongoing relationship during the year is necessary, because there's strategic points within the year that we will meet and say, okay, looks like you're about to phase out. Like if you continue trending this way, by the end of the year, you phase out. What can we put in place now to make sure that you don't? Right? So 20% deduction on your income, in some cases automatic, unless you phase out. You don't get that with W-2. You don't get an automatic 20% deduction of your income, right?
Because you're doing what the government wants you to do.
Exactly, right? I would say follow the intent of the law, right? The intent of the law is to get you to do certain things. And if you do it, you get rewarded. If you don't, you don't. Right? So that's one of the things that comes to mind. The other thing, so like R&D credits.
Okay.
Right? And what I love about credits, and that's the other thing too, one of the things people don't understand is there's a difference between deductions and credits, right? Deductions reduce your taxable income. Credits reduce your taxes, right? So it's all well and good to say you make, say, $100,000, say you make $600,000, right? And you get to deduct, say, 200,000 of that, and therefore your taxable income will be 400,000. But if you get a 200,000 credit and your tax liability was 200,000, it wipes away your tax liability.
Can you please get all of us credits?
Huh?
Can you get everyone listening right now credits? Everyone's like, I want credits. Forget it, I want credits.
So that's the other thing. That's when I tell people deductions are great, but there are other things, there are other tax credits, especially if you own a practice and things of that nature. But again, it's planning those things out. Like, what credits can you qualify for? Mm-hmm. Again, you have to meet the criteria, but we always look to see if you can or if you already do. So that's another benefit of business owners. You have that opportunity to wipe those credits. I'm just
curious because this is very nuanced. Now we're going into, and that's why we started with W2. Give me one or two examples for our audience that are listening of what credit, like what could give you a credit that could
the R&D, research and development. Right? Again, there are very specific rules surrounding that. Like I have one client who created a prototype, like an app or something like that. And it has to meet certain criteria, right? And it's very specific. So during the year, we track those expenses, right? And then there's a whole calculation. An expert will take those expenses and calculate what your credit will be based on those expenses. So if you're innovative, or if you created an app, if you created some type of prototype for something that meets the criteria that the IRS, everything is criteria. Right? Yeah, so it depends. If you meet that criteria, you get the credit. It has to be done a certain way. It has to be reported a certain way. You don't just, I did this, blink and get the credit. There's documentation you have to have, you have to have a specific calculation done. It's more than meets the eye, but once you plan for it, you get it. If you're innovative, and especially in your space as physicians, if you create certain things, you're able to get that credit. One of the other credits, and I'm not sure if this is going to continue in 2026. However, it's available until 2020 through 2025. It's called the pass-through entity tax credit, right? Now that credit is not available to all business owners. It's only available to you if your business is structured a certain way. So that's all the things. When I say structure, it's not the fact that you're making the income. It's like, how are you structuring your expenses? How are you structuring your income? Because how you structure it is what's going to get you the tax benefits, right? So pass-through entity tax credit.
Tell me about it.
So this one could be very, very confusing. I'm going to try to simplify it. It may not, I don't know if the simplification will work, but I'm going to try. So forgive me if after I say clear as mud, you say yes, clear as mud. Sorry, but I'm going to try to simplify this one for you. So how the pass-through entity tax credit works is, let me give you some folklore on it. A few years ago, pre-COVID era, that when the tax law was the overhaul of the tax law back in 2020. Before that, if you had state and local taxes, right? If you paid state and local taxes, you were able to deduct that on your Schedule A, right? Personally. With the Tax Care and Jobs Act, that amount has been limited to $10,000. So Before that, if you paid 100,000 in state and local taxes, you got to deduct 100,000. With the new law, if you paid 100,000, you get to deduct 10,000. So that 90,000, you no longer get that deduction, right? And you wonder why your tax bill went up, but you don't get that explanation. But these are the types of things, like when tax law changes, I tell my clients, okay, this is about to affect you. Let's see what we can do to mitigate that. So that's the work we do throughout the year when these tax laws change. What happened was some of the states were like, how can we benefit from this? Because it's state and local taxes, right? Now, in certain business structures, like the S corp does not pay taxes directly. So some states, not all of them, some states said, what we're going to do is we're going to implement what's called a pass-through, and it's PTET is short for pass-through entity tax. We're going to implement that. And how that works is we're going to have these businesses pay us taxes, like an additional tax, but we're going to give it back to them when they file their return. Now, state taxes are not deductible in your business generally, but if you pay that tax, they allow you to deduct it. So instead of getting the deduction on your Schedule A, you get it on your business because it's the same deduction. It's just structured. It's put in a different bucket to offset your income. It's offsetting your income in a different way. And then, now again, all the state laws are different too. So some of them treat it differently. So some states like Virginia, when you pay that tax, you get to deduct it. Other than that, you won't pay business taxes. You get to deduct it. And then they say, okay, take that deduction. When you file your personal return, your state personal return, if you owe anything, we offset it with what you paid in your business. So it's a credit. So it'll wipe away that credit. Now, the thing about credit is this is another, exception to the exception to the exception. Some credits will bring your tax liability to zero. So they say, okay, you have a credit of $20,000. You only owe $10,000. We're not going to give you the extra $10,000 back, right? So those are called non-refundable credits. But some credits are refundable, meaning if you owe $10,000 and that credit was $20,000, we wipe out that $10,000 and give you $10,000. See all the little intricacies. I hope that was clear as mud.
Oh, that was good, and it's one of the few. I think California does let us do that, which is California gives us no benefit for things. Mm-hmm. But thankfully, this is one that we can. I don't know what states don't, but it's just, I'm like, whose idea was it to eliminate that?
What on the deduction? On the Schedule A?
Yeah,
it was a Trump administration.
It's like.
Yeah, I don't know why. I don't know. But again, what did I say? The tax law is written for business owners. Who got the benefit of that?
Yeah.
And I always tell people this. Sometimes it might sound a little non-empathetic, but I'm like, if you're complaining how much you're paying in taxes, just go start a business, please.
Go start a business. But I have to say, though, this is really, really important, guys. For those of you that are listening, we talk a lot about strategies. We talk about real estate strategies, for people that want to do things like oil and gas, business and all of that. But I don't think there is enough conversation about entity structuring for tax purposes. And as you grow in your wealth, this is where your team has to focus on, because we think about entity when it comes to legal protection, like LLC and all of that, but you also have to make sure that your tax team is thinking in that perspective. Yeah. It's just a small shift can save you a lot of money.
Yeah, it's so important.
Ask me how I know.
It's so important because a lot of deductions are tied to entity types as well.
Yeah.
So even the way, you could have the same deduction in different entity types, but in order to qualify for the deduction, you have to do different things for each entity type. So you might talk to, and I find this a lot, but a colleague of mine said they did this. I'm like, you're not your colleague. your colleague probably has a completely different structure from you. It's the exact same expense, right? Sometimes the deduction is not deductible in your entity type and it's deductible in theirs.
Yes.
So you have to be so careful about entity structure. And that's why I say we find the most optimal mix, like which entity structure is going to save you the most in taxes. And I will say this, one of my favorite things to say, it's not always the S Corp.
It's not always the S Corp. It's not always the S Corp.
Contrary to popular belief, it is not only the
Give us one example of that exception. If you have any? I'm curious if you have any examples that come
so if you have, when you look at entity structure, you can't just look at the individual who's making the money in the entity. You have to look at the household income, right? Because however, like if you're married filing jointly, if your spouse's income is structured differently, right? It may, because of the way your spouse's income is structured, whatever you're trying to do, it nullifies whatever savings you're trying to do in the S Corp. Sometimes. So if your spouse is a heavy W-2 and you have an S Corp and their W-2 income is higher than your S Corp, it may nullify the self-employment tax savings. So you always have to do that analysis to see, is it worth it for you to become an S Corp? And I have situations where I tell clients it's not right now, but we monitor it and see if it is. Certain income thresholds. Now, if you have that situation and your S Corp starts meeting certain income thresholds, then it makes sense. So it's never going to be right for you. It's just not right now. You're actually paying more taxes right now. If you end up paying more taxes right now if you do it that way. But when you hit that threshold, and again, you have to mix the two incomes together. So it's not me saying if you hit 200,000, it's like, no, we got to look at the house. How much is your spouse making? You look at them together and to see, at what point is it going to be beneficial for you to make the S Corp election in a way that it actually benefits you.
This has been so good, and I know that we could keep going, but
I could talk about that.
We just may have to invite you back for part 2 because we got some more edges. Literally.
I hope I wasn't too mean.
No, you're trying to be mean. Listen, they were listening on a conversation.
Yeah,
so but what they get.
But it is a mindset shift. It really, really is a mindset shift. And if you can't make that mindset shift, especially when the other thing is focusing on the investment in tax strategy, people focus on that so much when they shouldn't be focusing on the investment in the strategy. They should be focusing on how much extra they're paying on taxes. Because most of the time what they're paying overpaying in taxes is way more. At least when you work with me, it's sometimes 200% more, 300% more than what the investment would be. That you're throwing away, 200 to 300% of your hard-earned money that you're just throwing away without.
Let me ask you a question, Natasha. So there are people listening right now and they're like, okay, this is great. I know that I could benefit from, having a tax person on my team, a tax strategist and all that stuff. What are some things that people should be looking out for when they're trying to find the right tax strategist for them? Like, what are some mistakes to avoid?
I think, now I'm going to say this, there is a lot of boilerplate tax planning going on right now in the industry.
Tell me about boilerplates.
Well, people are trying to do one size fits all strategies, which doesn't work. If you don't have the ongoing relationship, that could get you into trouble, because when you implement those strategies, you have to maintain them in a way that they remain compliant with the IRS law. So I would say, yes, it's great to have a tax strategy. Have them do a diagnostic first, right? Make sure that there's that ongoing component, because if there's not, you're setting yourself up, you're potentially setting yourself up to kind of go sideways, for it to go sideways. So I would say make sure, and I'm glad you asked the question to differentiate. Okay, you have the diagnostic, it's initial tax assessment, right? And then you have the plan itself, and then you have the ongoing maintenance. process. You have to have those three components.
So I'm going to be very honest with you. A challenge that many physicians really have when it comes to tax planning and tax strategy is they're like, many times I work with someone, it's working well, and then it seems like they get really busy. And now I'm no longer part of that relationship anymore. Mm-hmm. What your thoughts are about people that are listening right now, and that's kind of been their experience when it comes to tax, like, oh, Natasha is here, I'd like to talk to Natasha, but she may be too popular, like that kind of stuff.
Right. I think
like Natasha got 10 girlfriends. She ain't got time for me. You know what I mean?
No, I think that's the importance of the strategic touch points. So, for example, if you work with me, we're going to meet quarterly at minimum on a quarterly basis. But if a tax law changes that I know it's going to affect one of my clients, I reach out to them, even if it's pre or quarterly meeting. I say, let's have a conversation. Or if their tax situation changes, right? And because of their tax situation change, they now qualify for other tax benefits that they didn't qualify before. I reach out and say, let's hop on a call right now. Let's hop on a call next week. What's your availability? Right? So I'm always looking for ways to stay in touch with them. And then if you have a question, I'm available. You know, we have the quarterly touch points to make sure, because sometimes physicians get really busy.
Mm-hmm. Yes, right? We do.
So that's one of the reasons why those quarterly meetings, like if we don't meet for 3 months, we better have that quarterly meeting, because, you know, it's beneficial for you. We want to make sure that everything's working well. If you have any questions that, you know, you've been busy, now's the opportunity to ask those questions. Not saying that if anything comes up before those quarterly meetings that we can't meet. Absolutely, we can. Right? But we want to make sure that we have those strategic meeting points so that that connection is kept. I understand, like I think it's a matter of communication expectations, because I think, especially when tax season gets busy, it's sometimes hard to connect with your CPA. But if you manage, like I manage my clients' expectations and say, you know, during busy season, it may take 2 days for me to respond. But if you have an urgent need, put urgent on the subject and I'll make sure I attend to those. I'll give it priority, you know?
That's great.
I think it's a matter of managing expectations. I think because I don't think it's the fact that they're too busy for you. They're trying to prioritize work.
Yeah.
And if you set the priority of your needs, then we meet, at least for me, then I meet that.
And I think that's also the benefit of the long-term relationship as well.
Yeah. So that there's urgent, put time sensitive, you know what I'm saying? Put what the priority is, because some people could wait 2 days, and if they could, it's fine. Mm-hmm. But I think just managing those expectations so that they know, you know, I've had some clients say, I think this is time sensitive on there, you know, and then I'm like, yes, it is. Let's, you know, when are you available? Let's have a quick conversation. So I think a lot of that is managing the expectations. Just get clear on expectations before you move forward with the relationship, and see what their communication style is. Because I don't think it's like they forget about you. It's the prioritizing, you know, because sometimes they have to out fires for clients. And, you know, it's not that they don't have time for you. It's
they're doing their job.
Yeah. Getting clear on communication expectations, I think, is what will help that.
Okay. And if someone's listening right now and they're like, okay, I'd like to talk to you, Natasha. Maybe they're looking to switch. They want to do a diagnostic. They want to learn more. Where can they find you?
They can go on natashadornbush.com or yourmedicalcpa.com. Either one of those. And of course, you could hit me up on Instagram or Facebook.
Find her on Instagram or Facebook, and she'll be there. Natasha Dornbush, CPA.
Natasha Dornbush, CPA. That one. Yes.
Don't find another Natasha. We don't know what other Natashas out there. We ain't going to take responsibility.
Make sure it says Natasha Dornbush, CPA. Yeah.
So this has been very educational. I know that it's going to be helpful for our audience. of course, there's more conversations we could have. I mean, we're definitely going to have you back because I do think the W-2 to 1099 conversation about how to avoid pitfalls is something that many people will find super helpful. But I have to say, guys, for those that are listening right now, as someone that teaches value-based spending and all of that, the point of value-based spending is for you to spend your money on what actually matters, on what's going to move the needle, right? I talk about asset. As you're growing your net worth, it is completely, and especially if you have businesses, you can grow your net worth in a way that is simple within the stock market and it's straightforward and all of that. But if you're like many of my audience, they're called to more. They're building legacies, they're building businesses. I literally just got a message from someone today that's like, we just got $1 million in grant for something. Like, these are like, you guys are like killing it. This is the time to build your team. And when I talk about value-based, it's not just looking at the cost, it's looking at the cost, but in the context of the value that you're going to get. Because if I ask you to pay me $40,000, but you know that I'm going to give you $400,000 saving, $1 million saving, it becomes like, listen, I will go sell. Don't sell your kidneys, but I will be close to selling my. Like, the point is, make sure that you're building your team as you're growing, and it will cost you money at the beginning, at the front end, but on the back end, it will save you potentially a lot of money. And I'm saying that from experience, especially with first generation wealth building. Like, we're learning all the things, but we were not part of, like, many of us were not part of like CEO level meetings where our dads or moms were not introducing us to the, the CPA of the family, the strategies of the family, all of that stuff. You are the one that's building that. And so I definitely encourage you guys, if Natasha can be of service, please reach out to her. It's been a pleasure getting to know you. It's been a pleasure learning more about how you serve women physicians. And I have to say that this was a fantastic high value discussion with you. So thank you for spending your evening/night with us.
My pleasure. My pleasure.
All right, everybody. I hope this has been helpful. If it has, don't forget to leave us a review on whatever platform that you're listening to right now, whether that's on podcast, on YouTube, and share this with others, because we're on a mission to help more women physicians build wealth in a way that's sustainable, in a way that aligns with their value, and also promotes peace and wealth. Love you guys. See you in the next episode. Bye-bye.